What we've got is really a small replay of what we saw in the mortgage crisis.
More and more cases, I see more and more people with terrible car loans, just crippling car loans. They found struggling people and they're making a profit off those struggling people.
We're seeing a rise in predatory lending.
People like Capital One and then Wells Fargo, and there are new names I don't recognize, and they're in cahoots with the dealerships.
The axles, brakes, do I trust it? No. With all the issues, I do not trust it. I don't even know if my airbags work.
Last year, Jonathan and Marcelina Mojica purchased a 2011 Hyundai Sonata. Their total loan payments will amount to more than $30,000, roughly double what the car was worth.
It runs like an old car, but expensive to have.
The loan was from Wells Fargo, the same bank that rejected their application for a $10,000 personal loan just months earlier.
This is the worst choice I ever made in my life.
The process works like this. They target the people who are struggling financially the most because they have the lowest credit scores. And they use that as an excuse to charge them like illegal loan shark rates.
Because of my credit, I don't even know how Wells Fargo even decided to give me a loan for a car.
Last year, 1 in 4 new auto loans were to subprime borrowers with damaged credit histories, like Marcelina. Marcelina declared bankruptcy in 2012.
The financial crisis created so much distress in American households. So you've got borrowers who may have impaired credit history, they may have had a bankruptcy in their past and can't access traditional lending markets.
So since their credit score is damaged, their only chance at a car are these subprime rates.
We had received a flyer in the mail talking about you're approved for a loan.
All I would have to do is basically show up, pick what car I wanted, and then be able to get a loan, regardless of the fact if I went bankrupt or not. I know that when you take out loans and you pay off the loans on time, it does make you build your credit faster. I'd be able to maybe buy a house one day, and that's what I was thinking. So when I did see that flyer, I held on to it.
Now, these are all car loan solicitations, high-interest car loan solicitations sent to my bankrupt clients, people who have already filed bankruptcy. Here's one that looks like a check, and it's made out to $21,000. I guess it's going to be a used car, with a signature and everything, sent to one of my clients. Here's one that looks like some kind of an official certificate. They encourage you to apply for a car loan, even if you suffered bankruptcy, car repossession, foreclosure, or all of the above. What are these lending standards? I mean, could they possibly be much lower? Here's another one also that completely kills me.
Our car payments are about $500 to $600 a month. Almost twice as much as what we wanted to pay, and almost twice as much as what we were told we would have to pay.
The reason these people are being targeted after bankruptcy is, well, number one, they know they can't file bankruptcy again for 8 years, and the interest, which they frequently hide, it goes up to 21%. So they're buying a car that's already 3 or 4 years old. They're on a 5-year payment plan. At the end, when they're paying that car, and sometimes those payments are $600-700 a month, they're paying for a piece of junk.
Lenders defend those high rates, saying they are offering credit to those who could not otherwise get it. But there's an incentive, demand from Wall Street for high-yield investments in the wake of the mortgage crisis of 2008.
We're in a very low interest rate environment, and therefore any incremental increase in the yield that a lender can generate is a positive for them. And so the big guys with very little other opportunity for income growth, they're chasing into these markets.
Like Wells Fargo, the nation's second largest subprime auto lender, which made this pitch to investors.
Some of the specific strategies we like at the moment that are able to generate income are strategies such as consumer and infrastructure lending funds, including auto loans, railcar leasing, and pipeline financing.
Wells Fargo says its underwriting standards remain high, that it is not taking big risks on these loans. But consumer advocates say there's a reason banks are not losing money on these loans. Borrowers will do almost anything to keep up with their payments.
It is what it is. We have to. I have no choice. I mean, basically, the car gets more money than what we put in our fridge.
Right now, they're able to get very high returns on these loans, and we'll worry about the losses later.
As in the mortgage crisis of 2008, these losses could have a ripple effect beyond just the lenders, because, like mortgages, many auto loans are bundled into bonds and other investments that totaled more than $17 billion in 2013, a 7-fold increase over the last 5 years.
They're lending to the weakest borrowers, so they don't really care quite as much about the quality of the loans, because their attitude is, we're going to make the loan, we're going to pool it, we're going to package it, we're going to sell it off to investors, and we therefore don't own the risk, the investor does.